I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a bit of a regular guest. It couldn't be a better time for him to come on because he's an expert in finance, in markets. He runs his own portfolio strategy. It's Pento Portfolio Strategy, as a matter of fact. We're talking about Michael Pento. Michael Pento, thank you for joining us today on USAWatchdog.com.
Greg, I got to tell you, it's always a pleasure to be on the world's premier alternative site and one of the really true, real places you can get real news.
Well, Michael, I mean, I'm almost giggling over the Fed Reserve last week and Janet Yellen. The market perceives it, and rightly so, as dovish, this quarter-point rise. She's raising rates into, I think the Atlanta Fed came out, it was 1.2 or 1.3%, and I think that was revised lower. We've had, you know...
You're correct. As usual, you're correct. It was revised lower to, get this, with a zero handle, 0.9% Q1 GDP growth. I know the mainstream financial Keynesian-led media will try to convince you that the world is exploding in growth, but we have a zero handle here in the United States, a 1% handle in Europe, a 1% handle in Japan, and China, which is in a habit of always manipulating and massaging their GDP, even their doctored numbers are headed south.
What is going on? What's the idea then behind this ridiculous Fed rate increase? And quietly, we just bumped up against the debt ceiling, and that's going to be another fight. What's going on? What? I mean, it's almost goofy. She comes out and you know, it's perceived as dovish, and she's out. No, it's not dovish. What's going on with her?
It's not dovish. You know, it's not dovish. Here's what's going on. So first of all, let's get it straight. From 2003 to 2004. Mr. Bernanke took the Fed funds rate down to 1% and left it there for 1 year, from July to July 2000, June to June 2003, 2004. That engendered the housing bubble, which very nearly brought down the entire global economy. We now have, with this quarter-point rate hike last week, we now have the Federal Reserve, which kept interest rates on the Fed funds rate at 1% or less for 100 months. Now, that's not dovish. I have no idea what the hell these people will describe as dovish. But here's the thing. The Federal Reserve now is a victim of their own BS and their Keynesian groupthink mantra. Ms. Yellen and company on the FOMC, Federal Open Market Committee, firmly believe that they have solved all of the problems that engendered from the Great Recession. And those problems, again, were extent due to artificially low interest rates, asset bubbles galore, and a record amount of debt. They believe they fixed those problems by creating an international bond bubble, an international stock bubble, and an international real estate bubble. They believe now, because they're a victim of their own Keynesian BS, that they can slowly raise interest rates and everything is going to be fine. They will, by definition, even if they do it slowly in their mind, pop the bond bubble, they will flatten the yield curve, and they will engender the worst depression that we have ever had in the history of economics.
Yeah, you know, I wanted to bring this on. I'm holding this your book up. It is the book you wrote, I don't think it's in 2013. It's your book on the coming bond market collapse. I just want to give you everybody. This is on your website also too. The coming bond market collapse. Is this what's going to start the coming bond market collapse?
Listen, I believe what's going to. You look for catalysts around the world. So let's go over to Europe and Mario Draghi and the ECB. They've been printing 80 billion euros per month. This is strikingly similar to the $80 billion that we were printing here at the Federal Reserve. Mario Draghi is starting to taper this QE program. I believe he is going to start announcing a more aggressive tapering as we go through 2017. Now, here's the problem. People will tell you that we didn't have a problem really so much when the Fed began its tapering in December of 2013. But our 10-year note was 3% at that time. The German Bund is 0.4%. So a tapering by Mario Draghi later on this year, and I think it's going to be an aggressive tapering because inflation in the Eurozone is above 2% and rising. that means you're going to have an absolute slingshot, a vacuum created in yields, where yields are going to spike from 0.4% on the 10-year to above the rate of inflation very, very quickly. If that happens, that's going to drag up yields in Japan, drag up yields across the developed world, and drag up yields even especially in the United States. So you're talking about a global synchronized bond bubble collapse. And when that collapse, when that increase in interest rates occurs on the record $230 trillion of global debt, which is also a record 300% of GDP, that's when this whole chaos begins.
And what's the chaos going to look like? I mean, what is it going to look like?
It's going to be a currency chaos. So let's just take, for example, so the dollar, I mean, I find it amazing. The dollar can't get it's out of its own way. It can't get its sea legs. You know, the dollar hasn't gone anywhere but down this year. And this is in light of the fact that the Fed has announced they're going to do 3 rate hikes. Now, if Mr. Draghi or Mr. Kuroda announce a drastic tapering of their quantitative easing programs, then the dollar is going to absolutely crater. It can't go up if during unlimited QE in Europe and Japan and an actual rate hiking campaign in the United States. What's going to happen when Europe and Japan start to taper and then start to raise interest rates? Our dollar is going to collapse, so you're going to have currency chaos. By definition, you're going to have bond market chaos. I just described that a 0.4% German Bund has to skyrocket towards the rate of inflation, because what are the investors going to do? When they hear Mario Draghi's tapering, they know they're going to have to get in front of that massive offer. There's going to be a massive amount of bonds hitting the market from Mario Draghi. It's 0.4%. Inflation is above 2%. So you're going to have chaos in currencies. You're going to have chaos in the bond market. That's going to translate to chaos in equity prices. And, of course, that is going to derail this economy, the global economy, which has been built on a massive increase in debt and a massive increase in asset bubbles.
Could we reach a point where, I mean, Donald Trump in the 80s was skyrocketing. He got into trouble in the 90s, and he reorganized his debt, and he got the bankers to basically take a lot less. Do you think he might do that with our U.S. Treasury debt? We're not paying this $20 trillion. I mean, anybody thinking that we're going to pay the $20 trillion that we owe right now, and incidentally, I want to get into the debt ceiling, but do you think he might just call over to Steve Mnuchin and say, yeah, don't renew those bonds. We're going to hold them to maturity. Don't liquidate them.
You know, Greg, he actually alluded to doing something of that ilk during this campaign. But he's got a lot of very smart people surrounding him. And I think what he's going to do, instead of an explicit default, which is probably what we're going to end up doing down the road. But first and foremost, Donald Trump is going to do what governments and central banks do best, what they have proven to be very proficient at through history, and that is defaulting on debt through inflation. So let me take you through a scenario. So the Federal Reserve is going to raise rates. They did it 3 times in the last decade. They're going to go another 2 times this year. And that's going to bring our 10-year, our Fed funds rate very close to 1.75%. Now, here's the problem. The 10-year note is at 2.5%. You have to believe, you have to hope and pray that the 10-year note yield doesn't fall below the level of the Fed funds rate. I happen to believe that the economy is going to continue to grind along very slowly. Don't forget, as you mentioned at the top of the show, that Q1 GDP was 0.9%. You know, the last thing this country can stand right now, and I believe, by the way, let me just caveat this and explain to you that I think we need to normalize rates to get back to economic reality. But if you think that reality is going to be marked with impunity, you're sadly mistaken. So we're going to, and I know you don't think that, so we're going to raise interest rates. We're going to probably flatten out the yield curve. At that point, break-even spreads, inflation break-even spreads will contract. And if you look throughout history, and I've done extensive work on this, whenever the yield curve flattens, money supply shrinks, you're going to have a rapid increase in real interest rates, break-even spreads collapse, and we're right back in the middle of August 2008. And that's going to bring about the Federal Reserve changing monetary policy. They're going to take back their pitiful handful of rate hikes that they managed to get through before the economy collapsed. They'll go back into QE. And then she's going to start something else, because you can only reduce rates by the handful of rate hikes, maybe 4 hikes that she managed to get in, 4 or 5 hikes she managed to get in before the economy collapsed. That's nothing. 125, 150 basis points, even if it's 175, it's nothing. It's not going to help. She's going to have to adopt something known as helicopter money, which is the direct purchase of assets held by the public. She's going to do what they're doing over in Japan, which is buying stocks directly from the public, or directly buying debt from the Treasury. Forget about going through primary dealers or the private banking system. And that way they can get the money supply growing very quickly, get it directly into the hands of people, and you talk about a massive bout of stagflation, just like we had in the 70s, except worse. And here's the rub. In the 70s, and I did extensive research on this too, during the 70s stagflation, you found no solace in a balanced portfolio. Stocks went nowhere after falling 50% from 71 to 74. And of course, by definition, bond prices got crushed. So the pension funds are in trouble. The entitlement programs are in trouble. We are in for, after this next recession, a bout with stagflation like we've never seen before. That's what I believe.
Is this why gold and silver jumped on the news of a rate hike, which is almost like bizarre? Whoa, you were raising rates, but gold and silver, catch a bid and go up? Is that why they went up?
In my opinion, the reason why gold and silver went up is because Janet Yellen, who suffers from schizophrenia, much like most of her Federal Reserve chair people before her, she talks dovish, and then she talks hawkish, then she talks dovish. Well, prior to this, 3 weeks ago, the Fed funds futures market showed a 20% chance, 25% chance of a rate hike in March. 25%. And then I believe what happened is that there was a watershed moment at the Federal Reserve, because they look at stock prices. They look at the advance in stock prices, and that's what they do now. They have a lot of mandates at the Fed. The number one mandate is stock prices. They want to keep stock prices elevated, but they don't want them going up into bubble areas too quickly, which, by the way, they've already done. So Janet Yellen, she said, you know what, we can really raise rates. She probably called Goldman Sachs and said, hey, we are really going to raise rates in March. They started selling Fed funds futures, so the price goes down and the yield goes up, which basically that means that they're guaranteed to raise rates in March. And that's exactly what occurred. See, it's all about insider information at the Federal. That's my opinion. I mean, why in God's name, because there was nothing really that happened, no piece of data that came out, why would Fed funds futures go from a 25% chance to almost 100% chance in 3 weeks? But there's no other explanation.
But is the gold and silver market seeing inflation coming? Is that what they're saying? They're saying QE coming? Why did gold and silver go up?
Well, I was going to finish. So thank you. So they were gold and silver after what the Federal Reserve communicated to the primary dealers. The market was shorted heavily by Goldman Sachs. They thought Janet Yellen was going to come out and say, we're going to raise rates a minimum of 4 times in 2017, and then another 4 times or 5 times in 2018. That did not happen. And the reason that did not happen, because the last thing the Fed wants and the last thing the Trump administration wants is a very strong U.S. dollar. So she might have been told by Trump, hey, you can raise rates if you want to. Your job's on thin ice as it is, lady. But listen, if you go aggressively here after sitting on your hands for 8 years, well, she wasn't in charge, but the Fed, Bernanke and Yellen,
yes,
sitting on their hands when they had the notion that they wanted to put a Keynesian in the White House. Now all of a sudden she's scrambling like a mad, crazy woman trying to raise interest rates. Trump wasn't going to have that at all. There would be a revolt at the Fed. So they have to raise rates very, very slowly. They can't strengthen the dollar. That's what they believe. But I believe the economy is so very weak. And by the way, I have a lot of good company. The Atlanta Fed GDP Now model has me with a zero handle, 0.9%. The economy cannot handle aggressive rate hikes, even if 3. It's too much. It's going to flatten the yield curve, cause a massive correction in stock prices, probably later this year.
And so, and what was the idea then? Help me with this. Obviously, they know the same things you do. I mean, they have the numbers in their own dang Fed. It's 0.9%, 0.09%, or 0.9%. It's not even a percent. What was the big push to raise interest rates? Why did they feel they had to do it? For their credibility, to protect the dollar? What was the reason why they did it?
Well, the reason is, and this is their rationale, they want to put bullets in the chamber so they can take away interest rates once the recession begins. So as far away from zero that they can possibly get, as long as the stock market continues to go up, they're going to continue to slowly raise interest rates. So when the inevitable collapse occurs, and that's what the Fed does. The Fed is in the business of lowering interest rates, creating asset bubbles, which pile up the level of debt, then raising rates and collapsing the economy. That's their mantra. That's their MO. It's happened over and over again. Just that the occurrences are going to be much, much more dire as we go through time. So the Fed is trying to get bullets in the chamber. So they're going to raise rates slowly. The yield curve is going to invert. Break-even spreads are going to contract. We're going to have another catastrophe in the stock market and in the bond market and in the real estate market and in the global economy. And that is exactly what we do here at Pento Portfolio Strategies. We model that divergence between inflation and deflation, hedge against both, so you can be on the right side of the trade in either way the Fed zigs or zags.
And you're predicting that after this doesn't work and the economy continues to grind lower and we have a calamity in bonds, stocks, currencies, real estate, the whole deal, the whole globe, you're saying that they're going to reverse course and boom, boom, they're going to go back to QE, they're going to go to helicopter money, and they're going to take back all these rate hikes. Is that right?
Well, they have no choice. They have no choice. Listen, like I mentioned before, you know, security funds are running out very quickly. Medicare has been greatly increased. Medicaid has been increased. Pension plans are going to be insolvent. They have absolutely no choice. They can't sit and watch this deflationary collapse of asset prices. They've worked so hard, 8 years, building up the stock market, rebuilding the real estate market. You know, I watch TV now, and much to my shock, there's a plethora of shows about how to flip real estate. And this is happening 9 years after this implosion of real estate prices that sent them down 35% on a nationwide basis. So they have no choice. This is what they're going to do. They're going to do everything they can to rebuild the asset bubbles, but it's going to take a lot more than just lowering interest rates and a little bit of QE. They're going to have helicopter money, and I think that's going to happen right after we enter this next depression.
Oh, so you're calling this a depression. You think, and when does this thing start coming apart? I mean, the stock market's up. When does it start?
Listen, I don't use hyperbole here. I really don't like to use hyperbole. I say depression because I look at the data. The data tells me that we had the Great Recession that began in the summer of 2007. It ended in 2009. That depression, that Great Recession, which was headed for a depression, I mean, they were talking about not getting money out of the ATMs, massive bank defaults, and, you know, making the Great Depression in the 30s look like a Sunday picnic. You know, that was caused by 1% Fed funds rate, 1 year, and a housing bubble. You look at the bubbles that are extant today. You look at, we didn't have, you know, we had interest rates that were 5.25. We had 525 basis points of Fed fund reductions in the revolver, bullets in the gun, and we had our deficit, our national debt was $10 trillion. It's now $20 trillion. But look at Japan. Japan has 250% debt to GDP. They have an inflation target of 2% and a 0% 10-year note. The same thing pretty much exists over in Europe and China, which is the biggest bubble of them all, in my opinion. They have taken on more debt than any other country since the Great Recession ended, and their debt was taken on to build massive infrastructure with no productivity whatsoever, empty cities, roads and bridges to nowhere. So you have the entire globe that has massively, exponentially raised its level of debt and the level of artificial interest rates and the level of asset bubbles. You know, if you look at the stock market, the U.S. market, you look at the CAPE ratio, the cyclically adjusted PE ratio, median PE ratio. You look at price to sales. You look at total market cap to GDP. Most of these metrics are at all-time record highs, but the denominator in those equations, GDP, has been artificially boosted by what? 100 months of 1% or lower Fed funds rate. So then when I say depression, I think it's, in my opinion, unfortunately, absolutely unavoidable. Because what did they fix? They fixed absolutely nothing. They just made the economy exponentially more artificial and more reliant on free money, ZERP and NERP forever.
I don't want you to give away your technical advice, but just in general terms, where should people be putting their money? Should they be paying off their house, buying gold, silver, food, water, farmland, artwork? I mean, what should they be doing?
Well, right now I believe that, and I'm positioned for a deflationary collapse of the economy. I'm slowly positioning the portfolio away from where I was hedged inflation, more towards deflationary hedges, because I believe that the Federal Reserve is in the process of flattening out that yield curve and bringing inflation break-even spreads close to zero. So where do you want to invest in that? You want to kind of buy utilities right now. Utilities are working for us in the portfolio. You have to have at least 10% in precious metal shares, in mining shares. Physical possession of precious metals is mandatory, 10-15% of that. I am gravitating towards shorting high yield, and I'm going to be shorting small cap stocks in the near future. It's a gradual process. I'm watching the yield curve as it starts to flatten and invert, and then once you see those break-even spreads collapse, then you start heading towards the door. Aggressively short the market and aggressively aggressively long gold stocks, because I believe that's your only solace. The market is a bubble. It's going to fall at least 50% for starters before Janet Yellen gets the helicopter money, and you better be ready with not all of your money. You know, I have two portfolios here. One's a global yield fund. It's not actively managed, or not as actively managed, and that just buys globally diversified dividend payers, which work very well for us in the model portfolio. But you should have at least 20%, 25% of your portfolio in a model that will hedge against either intractable inflation or a deflationary collapse of equity prices in the matter of 2000 and 2008. And by the way, this is not just 2000 and 2008. It happened in 1987. It happened in 1974. We had a flash crash. We've had many, many incidences of the market losing a great portion of its value. I know that the Federal Reserve has brought the VIX, the volatility index, towards almost single digits. And it just doesn't move anymore because everybody knows what's going to happen. The Fed has your back, and there's going to be endless free money. That's changing now. And it's not going to be handled well by the economy or these asset bubbles. They're going to break hard, so be prepared.
Do you think the coming bond market collapse, where you forecasted in this book, which could have been written just like this week, do you think the bond market collapse happens this year?
I believe the bond market collapse happens this year. I believe it's already started in the United States. As I said, last summer it was 1.3% of the 10-year. We're now at 2.5%. I think we probably inch our way close to 3% before we started flattening and inverting the yield curve. And it's going to invert quickly, and it's going to invert hard. But I think it more likely starts in Europe. When Mario Draghi announces an aggressive tapering and takes that quantitative easing from 60 billion, 80 to 60 to 0, you're going to see a bond market revolt. The free market, whatever there's left of it, is going to start aggressively shorting bonds. You'll see yields spike in Europe, which is going to drag up bond yields across the globe. And that's when this thing could all unravel, and it unravel very, very quickly. I want to say this. Your viewers should put up a chart of the Greek 2-year note circa 2012, just to see how things can look nice and calm and normal, and then boom, it shot up from low single digits to 300% in a matter of months. So you better be careful, and you better stay tuned and attentive, not only to what I have to say, but your great channel, which offers your listeners a plethora of wonderful information.
Well, Michael Pento, you're a good man. And, of course, your website is Pento-Stock.com. Folks, he wrote this about 4 years ago, in 2013, I think. Is that right, 2013?
Yeah, about 2013, correct.
You could have written it this week. I mean, it lays it all out. You basically predicted what you're talking about right now. I think it's great. You have free information, podcast, and sign-up sheets. You're a prolific writer. So go to pentoport.com. That's the website. Michael Pento for Pento Portfolio Strategies. Thanks for showing off your brain and your wisdom here in the markets. Really appreciate it here on USAWatchdog.com. Michael Pento, folks, thanks for coming on, sir.
Always a great pleasure to be with you, Greg.